Welcome. My name is Lisa Ortner-Ghouze. Let's take a closer look at the state of the global economy, where the only certainty seems to be uncertainty at the moment. Is there going to be a recession? Is there not going to be a recession? Borrowing rates are at an all-time high. Until a few months ago, the Federal Reserve suggested that it would be reducing its rates. This week, central banks in the US, UK, Switzerland, as well as Japan, announced uniformly that they will keep rates as they are. So does this mean that we are maybe nearing the end of a global rate hiking cycle? Well, we're in luck, because here with me today is Kaushik Rudra, Global Head of Fixed Income Research and Head of Asia Research, who will help us to make some sense of what's going on in global markets. So Kaushik, welcome. And what's happening? How do we make sense of all of this?
Yeah, I think everyone's struggling. I think that's the short answer. The long answer is I think we are in a very difficult phase, and sort of surprising phase as well. We would have expected by now for the US economy or the European economy to be in a recession. When you think about the war that started with Russia and Ukraine, we have unprecedented levels of rate hikes in a very short period of time. It's surprising that these economies are still standing. And so it is definitely confounding as to which way it's headed. Our expectation is that we are definitely in a world where we are experiencing subpar growth. US, yes, has been much more resilient. Europe also has been more resilient, but they're all facing slowdown right now. There are various indicators we can talk about which suggest that the economies are slowing down. We also have obviously a very big inflation issue around in the world, which is the big challenge for most of these central banks, not because inflation has been seen after a long period of time. Until recently, ECB, Bank of Japan were desperate to get even a small amount of inflation. Now we have inflation. It's a question of controlling that narrative and ensuring that that stays within a certain range. If it starts getting out of range, then I think it becomes an issue for central banks to sort of bring it back from a longer term perspective. So clearly that's a big challenge for these central banks, and they will err on the side of keeping rates high for a long period of time to ensure that inflation starts coming down to more reasonable levels. Now, as far as growth is concerned, our expectation is that the growth in the US will slow down, perhaps avoid a recession over the next few months. But as we get deeper into 2024, we do expect a recession. In Europe, we've sort of navigated through touching recession, coming back, touching recession, coming back. So I think we will see more of that. The economy clearly will see the weight of interest rates, and that will have an impact on these economies. I think as far as your question is concerned, I think most of these central banks are either done or very close to being done. I think Bank of England may need to do one more, but most other central banks perhaps are, at least our view, is that they are done. The question really is, can we see rate cuts anytime soon? And unless we see a deep recession, we don't really see the need for a deep rate cut path, right? We may see rate cuts coming up from second half of next year and a very shallow trajectory of rate cuts thereafter, but we're not necessarily going to see that deep, easing of conditions. Now, one thing I do want to mention, it's not all doom and gloom. I think clearly you have the West, which is going to slow down. We'll talk a little bit more about this, I'm sure. But in Asia, things look a lot better, right? When we think about this part of the world, ASEAN more broadly, India, they're definitely looking very, very strong in the global context, but also on a standalone basis. There are various reasons for it. I have to say, obviously the country next door, China, is struggling a little bit, and that clearly is a bit of a challenge, and we'll talk more about China, I'm sure. But I think overall, Asia is in a much better place than what we see in the West.
And such a mixed economic outlook clearly has an impact on global trade and the shipping industry. So what is your outlook for global trade?
Look, global trade has been slowing down for some time. I think we saw an updraft in trade, but both in volume terms and value terms. Trade has been coming off, and I think that probably will continue if we do see more slowdown happening with respect to the US. more slowdown happening with respect to Europe, and a China which is not quite pulling its weight right now. Of course, Asia is doing well, other parts of emerging markets are doing reasonably okay, but that will not be able to take the offset of these major economies not necessarily growing at a very healthy pace. I think the other thing to consider is China again. I mean, I think China is currently being driven, or at least being transitioned more towards the consumption side from the investment side. Now, when China is an investment-driven economy, the world benefits from that. Trade benefits from that. Commodities benefit from that. Now we are seeing China pivoting towards consumption, which over time will probably be a good thing, but for the short term, that means you don't really get that boom for infrastructure, for investments, and global trade coming through from China.
Yeah, I was going to ask you, of course, about China, because it's such an important part of the economic outlook story. So I know earlier in the year, Standard Chartered's global research team, you were a lot more bullish on China. So how come you have revised your outlook?
Our growth expectation is still above 5%, and it's above what the Chinese authorities are sort of asking as a baseline. China, the government is happy with 5% growth. I think we're going to get above that number at this point. But I think the real issue is what I just highlighted. I mean, I think in the past, China has undertaken bigger stimulus programs. They've undertaken an investment-driven push when they want to revive an economy. Now, they are somewhat tied because of very high levels of leverage that exists in the country. So, it's sort of a binding constraint in that sense. So you cannot really undertake massive amounts of stimulus programs which are debt-driven like they have done in the past. So this time around, they were relying on the economy opening up, and that will result in a consumption boom. Now, we did see a very strong recovery in Q1 of this year. China did very well from a recovery standpoint, but thereafter, things have stalled somewhat, and there are reasons for that. Consumer sentiment in China is as low as I've seen for a long period of time. Now, why is that? Obviously, the COVID shock and sort of the lockdowns of last year still have some sort of a bearing on the psyche. But also, I think more importantly, if you don't really have much of a social safety net, as you do in Europe and other parts of the world, then you're reliant on your own savings. And where are Chinese savings parked? They're parked in the housing market, they're parked in equity markets, neither of which did well over the last year and a half. So, and clearly the housing market still remains in a secular down cycle for the time being. There is more trouble ahead, and we will see more consolidation in that space. Eventually it will recover, but in the meantime, the Chinese consumer clearly is limited in terms of his ability to come out and spend, and that is limiting China's recovery. Now, the other thing is, unlike in the past, we're not going to get that big bang stimulus program. We're going to get these nuanced programs which are more targeted. They do have their positive impact, but they don't have the big scale impact that we've seen in the past.
And, geopolitical tensions, which we're all very aware of, they have also had an accelerating effect for businesses to really kind of look closer at the China plus one strategy. You alluded to the ASEAN economies, to India just earlier, which clearly have been amongst the beneficiaries. So what's going on in these markets?
No, I think rest of Asia is doing very well. I mean, when I think of the ASEAN region, I think about India in particular, definitely in a sweet spot. India is definitely in a sweet spot. I mean, ASEAN is also doing very well. Now, headline growth may not be as strong as we saw back in 2022, but it is definitely very strong on an outright basis, and in the context of what we are seeing around the world, very healthy. I think number of factors, as you highlighted, this China plus one diversification strategy, certainly pushing a lot of FDI into ASEAN, into Malaysia, into Thailand, into a number of countries in the region, into India, and these countries clearly benefiting from that FDI flow. There are policies, which are supporting these regions as well, and growth is going to be relatively healthy. The other factor that is, obviously helping is intra-regional trade and tourism. Now we've seen, when we think about tourism in this region, for instance, tourism is back to pre-pandemic levels for the most part, back to 2019 levels. But when I look at Chinese tourists coming into this part of the world, it's somewhere between 15 and 20% of its 2019 level. So there's still potential upside if Chinese tourists actually do come back in a much bigger way. Now, we can talk about why that's the case, but certainly I think we have potentially more upside coming through. Final thing I would say about this region, I think they didn't really have a similar inflation problem as the West did. They did have an inflation problem, but I would say unlike in the West where it was demand-driven inflation, which means wage pressures, etc., in this part of the world, we've seen more supply-driven inflation. And with COVID restrictions and other sort of supply rigidities coming off, that inflation has come down. And when that's come down, central banks have had sort of the liberty of being able to pull back from that rate hiking cycle. So most of the central banks in the region are done. Now, question of rate cuts. Inflation still elevated versus pre-pandemic levels, and growth is still healthy. There's no rush to cut rates, but I think certainly the rate hiking cycle in the region is over, and that will provide some degree of support.
Ending on a sober note, I'm sorry to be a bit of a downer, but what do you see as the three main risks to growth going into 2024?
This is my favorite topic, and I apologies if I depress anybody. See, I think the first thing is really around credit markets in the US. Now, US has been very resilient, and it's definitely doing a lot better than most people would have expected. Similarly for Europe. But if I think about what's happening with regional banks, I think this is something for people to understand. Regional banks as a group comprise 25% of lending in the US. So individually those banks are small, but as a sector, they're quite large. Now, who do they lend to? They lend to commercial real estate, and they lend to SMEs. Now, when we think about why people say, despite such high interest rates or such adjustments in interest rates, why is the US economy so resilient? People talk about people have long-term mortgages which have been set at very low levels. Yes, I agree. Big corporates have been able to borrow money at very cheap levels, long-term money, and they're fine. I agree. How do SMEs borrow? SMEs borrow at the 6-month window, floating rate market. So when rates go up, they have a problem. How do commercial real estate borrow? I mean, they are also linked to this cycle, and they're dependent on these regional banks to lend to them. When you have a small deposit outflow from a bank, and I can talk about this with some degree of authority, having worked at Lehman Brothers myself. So if you have a small flight of deposits, whether it's wholesale or retail, you can deal with it. But when you have a significant outflow of deposits, it's a viability issue. And that's what these regional banks are facing right now. And effectively, their ability to lend from a limited balance sheet to these sectors which are already struggling is very limited. So there's going to be a sort of knock-on impact that comes back into these banks. And I think that clearly will be a challenge. Now, these are big lenders in the economy, and that's going to be a consequence for the economy. The other factor that is very important is we've had, 525, 550 basis points of interest rate increase in the US and in Europe, similar increase in Europe. What do we have to show for from public market standpoint? Which market is really struggling? Equity markets still doing very well. Most credit markets are doing very well. In fact, spreads are at their all-time tights. If you take the last 10 years, they're actually doing extremely well. So which is the sector that is really struggling? The answer really lies in the non-transparent, non-regulated private credit and private equity, the non-banking financial system. They are massive lenders in the economy. Now, over the last 10 years since Lehman happened, they have become the marginal lender in the system. Where no one wants to lend, they're the ones who lend. So as a result, and by the way, we can't see what the extent of the damage is on their balance sheet because they're non-transparent. But what we do know is their ability to lend going forward is compromised because their leverage ratios are much higher, and they have taken mark-to-market pain, even if they don't officially have mark-to-market. They've taken pain because, interest rates going up has clearly been hurting them. So those are two important factors that I think we need to watch for, which will clearly result in higher levels of defaults, higher levels of delinquencies. We are already seeing some of that. As the individual level, we are starting to see higher levels of credit card delinquencies, housing market issues. So all of these things will come to the fore. And the final piece, as you highlighted, is geopolitics. Now, obviously, geopolitics will play an important role. There are a number of potential flare points. I don't think we have enough time to talk about that, but I think that clearly is another factor that could potentially be a worry for the world.
Ladies and gentlemen, Kaushik Rudra, Global Head of Fixed Income Research and Asia Research. I am sorry we didn't have time for a questions and answers session. Unfortunately, Kaushik has to go back to the office, but should you have any questions, he allowed me to give you his email, not his mobile number, but his email. So come and find me. I will be here all day today. Don't go anywhere, because coming up next is a session entitled Unprecedented Liquidity and Ample Risks. Sounds very promising and intriguing to me. Please stay with us. Thank you very much, and goodbye.